to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day, so let's get to the 3 market catalysts we are watching this hour. First up, the shift to non-U.S. equities, why one guest says emerging markets are likely to lead earnings growth next year. Plus, the Federal Reserve's Beth Hammack pushing to hold rates steady into the spring, why she's more concerned with inflation than the labor market. And the outlook for biotech in 2026, we'll take a look at top picks in that sector. First, let's get a check on the major averages here this morning. We are seeing all 3 major averages in the green here. Right now, the Dow's up about 100 points, call that about 1/5 of 1%. The S&P up almost 1/2 of 1%. The Nasdaq Composite leading, so a little bit of a modest rally here as we head into the new year. Small caps, though, are outperforming large caps, at least in today's session. And just taking a look at the year-to-date movement in small caps, there were a lot of people who thought small caps would outperform this year, that this would be the year they were coming back. That hasn't quite come to pass. The Russell 2000 up about 14.5% year to date. The S&P up closer to 17%. But we did see sort of a little bit of a catch-up trade going into the waning part of the year. One other asset that I want to check on here this morning, crude oil. Now, obviously, has had a big down year, and prices have come lower as there has been ample supply, but we are seeing more of an upward move as we see tensions continue to ratchet up with Venezuela. In the latest move, we see U.S. authorities stopping boats that have Venezuelan oil on board, even in some cases that are not sanctioned vessels. So we'll see how that all develops, but that has been pushing those oil prices higher. It has also, by the way, been pushing energy stocks higher. The XLE, the energy ETF that tracks that sector, is the best performer in today's session. And if you contrast that with the year-to-date move and what we've had in energy, it's up a relatively paltry 3.3%. So a bit of a comeback over the past couple of sessions for those oil stocks here. We've also got consumer discretionary and financials performing in today's session. And then we like to check on what's going on in the NASDAQ 100 here. NVIDIA shares are higher after a Reuters report that it was getting ready to ship H200 chips into China early in the new year. So that's been helping. Tesla shares standing out to me today as well, up about 2.25%. Meta shares up 1.8%. Well, moving on, let's broaden it out here and look at the S&P 500 on track for its 3rd straight year of double-digit gains, up more than 16% in 2025. But you know what's done better? International stocks. My next guest says 2025 will go down as the first year of the shift to non-U.S. equity leadership. And indeed, that's what we saw this year. We're showing here the S&P 500 up about 17%. MSCI, excluding the U.S., up 28% this year. Jay Pelosky is here with us, TPW Advisory founder. Indeed, we saw this outperformance this year, Jay. Is that going to continue next year, though?
Yeah, we definitely think so, Julie, and it's great to be with you. Happy holidays. Look, these moves when leadership changes in global equities from the U.S. to non-U.S., they don't last for quarters or for months or for even a year. They last for many, many years. The average is 7 to 8 years. The U.S., as a reminder, was the best performing stock market in the world from the bottom in 2009 through 2024. So we're way past due for leadership going elsewhere. And we think a number of factors, including global growth, a weak dollar, a commodity super cycle, all lead to continued non-U.S. outperformance. So we look at 2026 as year 2 of what we think is going to be a multi-year secular change in leadership away from U.S. equities.
Where in particular do you think that money will be flowing?
Well, we're very constructive on emerging markets in particular. EM has been the leader this year, outperforming EFA as well as the United States. And we look at China. We think China is very attractive. We talked a lot about the Trump administration's national security strategy document in our recent monthly, noting that China is no longer viewed as a pivotal enemy, but more someone to work with on the economic front. We think this is the lead into a rapprochement between China and the U.S. When President Trump visits China next spring, that will signal, it's an okay signal for U.S. institutions to own Chinese equities, which they haven't really done since Trump 1.0. We also like Latin America. We think Latin America is very attractive. has a great commodity exposure. And also Brazil, which is the biggest market there, is about to launch a significant rate cutting cycle in our view. Real rates in Brazil are at 10%. We think you could see 400 basis points of rate cuts in Brazil next year.
You mentioned the commodities super cycle, and I know that includes some bullishness on oil, which is a little bit out of consensus, right? Jay, I've seen some estimates out there that oil's going to kind of remain in this range because of the ample supply out here, sort of the Venezuela situation notwithstanding. What do you see that those folks maybe don't?
Yeah, no, that's a great point, Julie. And, you have to have something that's out of consensus, right? I mean, I think at this point, non-US is becoming more of a consensus. You can just tell by the performance in EM that you highlighted. And so, look, for us, commodity cycle history is pretty clear. It starts with precious metals. We've had that this year. Gold miners are up 150%. It moves to industrial metals. We have that. Copper miners are up about 70% year to date. And then it moves on to energy. And as you point out, that has yet to happen. And so as we look at it, it's a really attractive risk-reward environment, mostly because everyone and their brother knows that there's a huge inventory glut. Wall Street has a Brent forecast for next year of $52 to $55. It's currently at $61. And so all the bad news is in the price. And we love when those situations take place. And we've witnessed over the last month or two, continued talk about OPEC Plus adding capacity, adding production back to the market. And what does XLE do? It does nothing. It sits there. And so the bad news is in the price. Lots of upside if we get the global growth that we're expecting, if we get a situation where demand is better than expected. And look, we think that there's just a limited amount of low-cost capacity in the oil and gas sector that is yet to be exploited. And so these prices, all you're doing is basically shelving production, you're shelving exploration. And so we think we're setting up for the opposite of an inventory glut and inventory shortage in the next 12 to 18 months.
Very interesting. We'll see how that, we'll hold you to that and see how that plays out, Jay. Jay, just hang on a second. I want to bring in somebody else into this conversation and center it a little bit more on a particular sector. Chris Whalen is joining us now, Whalen Global Advisors Chairman. Jay Pelosky is still with us because I'm interested to get Jay's takes on the banks too. But Chris, obviously you're really steeped in the banking industry. What do you think is going to be sort of a predominant theme for banks next year? We've got rates coming down. We're coming off a pretty strong year, certainly for performance and stock performance. So what are you going to be watching most closely?
Well, I think kind of more of the same, Julie, and happy holidays, by the way.
You too.
Credit costs on the consumer side continue to fall. This is a year trend, by the way. We were looking for a recession, never happened. The commercial side is still a source of pain for the banks. You're going to see more surprises, more idiosyncratic loss events coming out of things like private equity and credit. But mostly the banks are getting back their earnings mojo from the lows of COVID in 2021. We got return on assets almost up to 1.4%. Across most of the better performing banks, and that'll continue. But I would caution everyone that this is not a very exciting picture. Banks are underutilized. They are being disintermediated by the non-bank sector pretty aggressively. And I think you're going to see some surprises coming out of non-banks, not necessarily happy surprises in terms of credit, because, we're into, as Jay was saying, we're into a multi-year, decade-plus rally in the U.S., and we've seen a lot of credit creation, not all of which is perfect by any means. And so you're going to see more first brands, more tricolor type default events coming out. On the commercial side, the consumer is still a snoozer. On rates, short-term rates, yes, but I think you're going to have a more hawkish Fed coming into the new year. You're going to have some changes in the voting members of the FOMC. And, it's possible they may not cut rates for a couple of months, which will obviously not make the White House happy. Meanwhile, the long end of the curve has been going up. Most people, for example, are looking for modest increases in mortgage volumes this year. And that was not what we were talking about 6 months ago.
Right. So, yeah. So we'll see how all that shakes out. But maybe, as you say, not so exciting on the consumer side. What about for you, Jay? What do you think?
Bad.
Yeah, it's not bad. It's just not, blockbuster, I guess, is, So, Jay, what does that mean for bank stocks and what you want to do with your portfolio with these guys?
Well, I've been around long enough to know that you want to listen to Chris when he talks about banks. So I'm not going to say anything counter to that in terms of U.S. banks. But we do global macro investing at TPW Advisory, and so we have the world as our oyster, and we've been quite keen for some time and remain quite keen on European banks. And European banks, the ETF we use is EUFN. They're up 60% year to date. Again, massively outperforming the U.S. banks, which are up about 14%. And so we like European banks. We think there's a credit cycle that's starting to roll out there in Europe. We think European growth is going to pick up. We think the consumer is fine. So we own U.S. banks as well, but we are more keen on European banks and in emerging markets as well. There's a great opportunity, we believe, in emerging market financials. So we like the financials broadly as a cyclical play, but we would probably put the U.S. banks third behind European and emerging market banks in terms of kind of relative positioning.
Gotcha. And guys, I want to hear more from both of you on this whole private credit risk debate that really has been a hallmark of this year. Chris, you mentioned it. We did have the First Brands. We did have Tricolor. We had, on the one hand, Jamie Dimon talking about more cockroaches, but on the other hand, the word I heard more than any other to describe all of this is idiosyncratic, right? It's a one-off. It's not a big deal. Is it a bigger deal, and how will we know when it's a bigger deal if it is?
Well, the irony, of course, is the one name we've been talking about the past few weeks is Oracle, right, which put on an awful lot of debt to chase the AI, race. I worry about this simply because Oracle is such a great company. I followed them for decades. And, the fact that they are willing to double down, triple down on this spend on AI really concerns me because I don't see a lot in AI that we're going to be able to monetize in terms of generating revenue. I think consumers will benefit, but like many things in technology, it's going to be hard for the providers to charge for the service. So I have all kinds of tools online. I have tools that we now see being used by vendors to manage incoming inquiries from consumers. Great. But are you going to be able to monetize these tools and generate revenue to help offset the spend? I don't know. It reminds me of memory chips. Every time a new memory chip comes out and they have vast capital expenditures to make these chips, they fall down to the price of the old chip almost immediately. And you think to yourself, how could this happen? And it's a consumer market. That's just the way it works. So I worry about revenue, Julie. I think there are many companies out there that are over-levered, that have over-promised, and we'll have to just see how it happens. But they will be surprises.
Yeah, we had a couple of them this year, and there's the whole sort of business development companies as well that maybe are causing some concern. Jay, how are you thinking about that whole credit picture?
Yeah, no, I think it's interesting to see that we are starting to see, as a result of this, I think, differentiation amongst the Mag 7 and these big names that have been really driving the market for the last several years. I think that's healthy. I also think kind of the dispersion of credit into the private credit space is also healthy, right? Because otherwise this would be on the books of the big banks and would have more concerns from an equity perspective about the exposure. So I think the evolution of private credit also spreads out the risk, as you said, Julie, kind of it's idiosyncratic perhaps on the issuer side. It's also more idiosyncratic on the holder side, which ultimately is kind of more important from a systemic financial system point of view. And so you mentioned the BDCs. We've actually taken a position in one of those over the last couple months, thinking that this has kind of gotten a little bit overextended. And Chris mentioned Oracle and the CDSs. Everybody's glommed onto Oracle, and their CDS spread is like the thing to watch. That tells me it's pretty far down the line of having been, kind of exploited already by markets. And so it's interesting to us. We own one of the big BDC ETFs, and it's outperformed the ag over the last 2 months. And it got a yield of 12%, and so we're gonna get paid while this thing plays out. And I think that's not a bad way to have some exposure on the other side of this, because I think it has been pretty well exposed.
Very interesting. Got to leave it there, guys. But let's meet up again in the new year and talk more about all this stuff. Happy holidays to you both.
Same to you, Julie. Same to you, Chris.
Coming up, the president of the Cleveland Fed says interest rates should stay steady, not just in January, but for several months beyond that. We'll have details on that next. Cleveland Federal Reserve President Beth Hammack says interest rates should be held steady at least through the spring, telling the Wall Street Journal she's more concerned with inflation than the labor market. Joining me now, Federal Reserve Correspondent Jennifer Schonberger, as well as Robert Sockin, Citi Senior Global Economist. Jen, what stands out to you from these Beth Hammack comments, especially as they relate to the rest of the Federal Reserve members?
Yeah, so what stands out to me is she's not a voting member this year, but she will be next year. And she believes that the Fed is actually below her rate of neutral at this point. That's a level designed to neither spur nor slow economic growth. So she sees policy as slightly accommodative at this point, at a point where we think the economy, and she thinks the economy, is expected to pick up next year. And she's hearing from contacts that they are seeing increases in costs due to tariffs, and they do want to pass that on to consumers. So if we see a stronger economy, she is concerned we could see inflation hold in there and hold steady. Of course, if the labor market deteriorates, that would be another story. But I think the real issue right now is the Fed is getting distorted data. If we look to that CPI report from last week, Hammack said that she thinks that it's underestimating inflation by as much as 2 to 3 tenths of a percentage point. And so headline CPI is more 2.9 or 3%. In contrast, New York Fed President John Williams thinks it's only underestimating by 0.1%. So not only do you have conflicting views in the Fed about the outlook for employment, inflation, what the Fed should do, but now conflicting views on how distorted the data is. And I think that may be with us for some time.
Yeah, and I want to get Rob's take on that in a minute. But first, just another question for you about the dynamic and the makeup of the Fed. Stephen Myron saying in an interview this morning that he might be sticking around for longer, depending on a replacement and whether they're confirmed.
That's right. So Fed Governor Stephen Myron was appointed by President Trump to serve out the remaining months of former Fed Governor Adriana Kugler's term. And that is expected to end at the end of January. However, it depends who the president is going to nominate to put in that position, because that person is probably going to be elevated to Fed chair. And the president has said he's expected to make an announcement early in the new year who that next Fed chair will be. However, making an announcement and getting them actually on the committee is going to take time because, Julie, as you know, that person is nominated by the president, but then needs to go through a confirmation process where they have a hearing in the Senate Banking Committee. The Senate Banking Committee has to confirm them, and then they have to be confirmed by the full Senate before they can assume that position. So Myron indicating this morning that he may stay on in the interim for that.
Yeah, so a lot to watch and a lot to talk about. So Rob, I want to turn to you on this. First of all, on the sort of competing concerns, the dual mandate of the Fed, labor, inflation, which are you more concerned about right now?
Yeah, absolutely. I mean, this is highlighting a fascinating set of issues, and the Fed is really stuck between this inflation that is still elevated, may even be more elevated and likely is than the most recent report suggests, as was just discussed, and well above the Fed's target. At the same time, the labor market continues to show signs of softness, gradual deterioration. The unemployment rate is rising. It's still low, but it's been marching higher and as much higher it's been over the last few years. If I were the Fed, and this is our view at Citi, I would lean more on the concerns about the labor market. When the unemployment rate is rising, it tends to rise historically, keeps going when it rises beyond a certain point. So there's a lot of risk there. And we think that the inflation that we're seeing is largely tariff driven and is largely going to be a one-off that will subside as we go through 2026. And we also think rates are above neutral. That's another area of heated debate. And so the Fed should continue to add accommodation. Now, when they do that, at what speed and how much is a big area to debate. But we would lean more towards the labor market's the more concerning element, and the Fed should be gradually cutting rates or at least adding some more accommodation in this environment.
Gotcha.
Robert, if I could just jump in and ask you a question. I'd mentioned the distortion of the data. We know that one of the reasons CPI looked lower was because of shelter, that rents are coming down. We know that CPI is more heavily weighted towards housing and rents than the Fed's preferred measure of inflation, PCE. But I was reading over the weekend that it could take up to 6 months given the way that rents are collected and tabulated into the CPI calculation, to get an accurate reading on CPI. Do you agree with that? Are we going to have to wait 6 months before we get accurate data? And then does that keep the Fed on hold, kind of?
Yeah, this is a key question. I mean, there's sort of these structural calculation type issues where it takes a long time for changes in the housing market, even when data are functioning properly, to move into the official inflation numbers. So we are seeing a lot of upward pressure in goods due to the tariffs, but we're seeing downward pressure in inflation in other areas, in particular housing-related inflation, as you noted. But it's going to take a lot of time for that to feed through the system. At the same time, we've had that government shutdown earlier in Q4. That's going to still create a lot of noise in the data that's going to take at least until probably early next year to fully filter through in the monthly numbers. And then you have to think about how it affects the year over year. That's going to be with us for a while. So bottom line, lots of challenges in the inflation data. We think the underlying current is somewhere around 3%, give or take, for core inflation numbers. So you are dealing with sticky inflation that is distorted. At the same time, there's also distortions within the labor market data that make it hard to read because of the government shutdown and other changes in the economy. So very difficult economy to read at the moment. And that's why I think for the Fed, you have to pick where you think the biggest risks are. And I still think, given all of these issues, the bigger risks are in the labor market, that you get a sharper deterioration there.
But do you think there is a risk, as Beth Hammack points out, do you think it is safer to just wait until this becomes more clear? Or do you think there is a risk from waiting into the spring that the labor market will deteriorate further?
This is the biggest challenge. And, frankly, we have a lot of debates even within the economics team about how fast the Fed should be moving. And we pretty much all agree about the amount of cuts that you would see from the Fed. I think we're broadly aligned with where the market's been. But the question is, should they pause as we go into early next year, or should they continue cutting? And I think there, it really depends on how much more does the labor market soften in upcoming data. I mean, we did see, as again, the unemployment rate moved notably higher. But you look elsewhere in the labor market, you're still not seeing layoffs pick up. And that is an area where tends to be the best signal of when you're moving into a downturn. And as mentioned earlier, there are a lot of reasons to think the economy could be stronger next year. You have fiscal stimulus coming through from the big, beautiful bill. So I think risk management wise, there's a very strong case for them to wait, even though I think they should be cutting. That being said, if you continue to get a rise in the unemployment rate, I think they're going to be moving early next year.
Something that I've been asking a lot of economists lately is, when the Fed cuts, what is that transmission mechanism to the labor market? Because I think, I've talked to some folks who say it's less than it used to be, or it's not as effective or immediate. So how do you think about that? What good does it do when they cut rates in terms of helping the labor market?
Yeah, absolutely. I mean, this is a question we get a lot is, do the interest rate cuts really do much? And I would say when you look at certain areas of the economy that are feeling pressure, and we can look on the consumer side, I think it's lower income households that are feeling more pressure than upper income households, which continue to do quite well in this environment. And you look at the business side, it's small businesses and more medium-sized businesses that are feeling pressure. The large companies continue to do well. And you can see that reflected, for example, over the last year. Where have you really seen a softening in the labor market? It's been from smaller firms. Larger firms have continued to do quite well. So as you cut interest rates, I think it takes some pressure off of those interest rate sensitive consumers and interest rate sensitive businesses. So smaller businesses that maybe need to access capital more, lower income households that maybe are more exposed to rises in credit card interest rates, things of that
auto
nature.
loans,
Exactly. Auto loans is an area we've seen a lot of strain. So I do think it helps, but to your point, it's probably not as strong of a boost to the economy, or maybe as fast as it would be in prior cycles, because there's all sorts of distortions. Good example being the housing market. A lot of consumers, a lot of people who own homes are locked in at very low mortgage rates. So even as you're lowering interest rates a little bit, it's really not changing the dynamics in the housing market all that much.
Right. Well, it'll be a very interesting year. Whatever else your predictions say, it'll be another interesting year.
Absolutely.
Rob, thanks so much for coming in.
Thank you.
Good to see you. And thanks to Jen as well. Coming up, top calls from Wall Street analysts as we count down the final trading days of the year. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Palmer. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. We're watching Hut 8, Oracle, and Ollie's Bargain Outlet. First up, Hut 8, because benchmark analyst Mark Palmer raised the stock's price target to a street high of $85. That was up from $78. Now, this comes after the company recently signed a $7 billion data center deal. The analyst said the transaction combined super deal economics relative to pure deals. The average 12-month target on the street is now at $65, and there are 17 buy ratings with 0 holds and 0 sells on the street right now. Next up, Oracle. Wells Fargo analysts are projecting that Oracle stock has nearly 50% upside potential. They believe that the current pessimism surrounding AI investments is a bit overstated. In the last 3 months, though, the stock is down around 40%, and Wells Fargo's price target is now $280. That's a little less than the average 12-month price target on the street of roughly $300. Last up, Ollie's Bargain Outlet. Loop Capital Markets raised its rating on the stock to buy from hold. Analyst Anthony Chukumba thinks the off-price chain is well positioned for the holiday season as consumers trade down from higher price alternatives given the uncertain U.S. macroeconomic environment. The firm also raised its 12-month price target to $135, and that's just below the average target on the street of $142. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
AI has been the biggest story of 2025, dominating markets and headlines. Yahoo Finance's Jared Blickery spoke to Matt Calkins, the CEO and founder of Appian, a cloud computing and enterprise software company, about his 5 AI predictions for 2026.
Matt, thank you first for joining us here. Let's go through this and start at the top, talking about these federal AI regulations. What do you have there for us?
There's going to be a battle in AI regulation in 2026. It's going to be the federal government against the states, and you saw that in Trump's recent announcement. There's going to be a clash about whether the states are allowed to make regulation and whether the federal government is going to withhold broadband funds or go after them for constitutional violations. That'll be one battle. There's going to be another little battle between Republicans who believe in states' rights and Republicans who believe in presidential authority, so look for that as well. And then finally, there's going to be a battle between European regulators and American AI companies, and that's going to be a sequel to the several battles that major American firms have been fighting with European regulation over the last 5 or 10 years.
And how does that play out among some of the biggest names that we know in AI, whether it's the hyperscalers, OpenAI? Are they going to have a stake or a horse in this race?
Oh, yes, they are. They would prefer not to be regulated. They would like a blank slate in which they can operate at will, and they'd like to deal with very few state-level regulations, ideally 0. For that matter, they'd like to not follow European regulation, or not at least the onerous part of it. So yeah, the big AI firms want to be under-regulated.
And your prediction number 2, AI will become valuable at an industrial level. And I think this kind of speaks to the trend that we had this miraculous technology that came out, but how are we going to use it? How is it going to improve our lives? And how is it going to fit into businesses? That's finally becoming a reality.
It's finally going to be a reality. We've gone years with the excitement of the idea of AI. It's the world's greatest science project, but it hasn't really moved the needle inside major organizations. And 2026 is going to be the year. At the same time as the AI technological revolution is, if anything, appearing to slow down a little bit with the models converging and the power plateauing, at the same time as that happens, you're going to see the most powerful impacts made to big organizations that we've seen in the whole revolution. That's because businesses are figuring out how to make use of AI. You don't put it on the side and ask it to do side jobs. You have to weave it into the most important thing businesses do, which are complex processes involving hundreds of people and hundreds of steps, all working together in great coordination. It's hard to fit AI into that, but when you do, it's going to be really valuable.
Couldn't agree more. The question is when. Got to move on here. Prediction number 3, and I love this one. The best investments will be purpose-specific models like small language models. And small language models abbreviates to SLIM. That's your acronym there, because we talk about the large language models a lot. How are the smaller ones going to upheave things?
I think this is the year we realize AGI is the wrong target. We've been talking about it for years. We were talking about making AI that's as smart as a person, and I think that's just the wrong direction to invest in. You see the success that open models are having, that small models are having. This is the year when public understands that we need practical AI, not experimental theoretical AI. And so there's going to be less investment and less focus on building an AI that is comparable to a person and more on building AI that can do a specific job really well. You don't need it to do every job. You need it to do the job in front of you. In order to make AI a practical technology that matters in big organizations, it can be a lot more focused than it is today.
Well, I like the notion that that's going to cost potentially a lot less money, and I'm wondering how that's going to affect some of the biggest players like OpenAI and then the Claude Maker. How is this going to affect these companies that are just outlaying hundreds of billions of dollars, soon to be trillions?
I think it opens the door for other vendors to become powerful winners in the AI market. You don't have to be a maker of human scale intelligence in AI in order to be a big helper to businesses. You could see specialists in different fields, legal, healthcare, transportation, tuning their own AI models and creating tremendous effect and great value for major organizations without the degree of money outlay, the same capital investment that our largest AI firms have made. This is going to democratize the AI market.
I'd love to see that. Nevertheless, the spending is going to continue, which brings us to prediction number 4. 2026 will be focused on AGI scale, fueled by power, data, and processing.
Yeah, the scale game just doesn't stop, and it's astounding how much money is spent. I liken it to laying the railroads across the nation, or the Eisenhower highway system, or the moonshot. It's an astonishing amount of money, and it's not going to stop because investors are still willing to write big checks. However, I think over time we'll see that there are other great ways to get a return on AI other than creating the next moonshot. So I believe that the returns on that investment are going to be a little smaller than some people are expecting, but there will be continued investment.
And here's another one that I find really interesting. Prediction number 5, the AI winners will have better brand and distribution. And I think about a company like OpenAI. I'm not trying to pick on them here, but they don't have the distribution. They're backed by Microsoft, but Microsoft is exploring other partnerships right now. And you kind of have to own the hardware, and they don't necessarily have that in right now. So how does this fit into your prediction?
I think the balance of power shifts toward those vendors that own the customer, own the eyeballs, have the brand power. I don't think OpenAI has the same kind of top position in that future world. I think they've got great technology, but the difference is narrowing. And if they can't rely on having a major tech advantage, then the battle shifts to a distribution advantage, and being present on the desktop becomes the greatest asset. And then in that case, I would expect other organizations to be even more successful.
Coming up next, we hear the word sentiment tossed around a lot. Jared Blickery will tell us what it really means and how it affects the market. Stocks in Translation is next.
It's the feel-good time of year, so on today's Stocks in Translation, we are breaking down sentiment. And let's be honest, feelings, they are messy. They're hard to quantify. You can ask 10 people how they feel, you'll get 10 vastly different answers. But the way we use it, sentiment is really just a catch-all term for a whole bunch of moods about the economy or markets, from optimism and bullishness to pessimism and bearishness. And for better or worse, all of them have a number attached, which helps us track changes over time. And different sentiment indicators measure different feelings. That's why they can disagree, and that's why they're useful. So let's take a look at the different types of sentiment indicators, which we can think of as a toolkit. Now, this isn't quite exhaustive, but it's getting close. We have the University of Michigan Consumer Sentiment Survey, also consumer confidence. That's how people on Main Street feel about their money, jobs, and prices. Some surveys pull investors, like the Investors Intelligent Advisor Sentiment. That's the Wall Street newsletter crowd. That's what the market commentary class is recommending. And then there's the AAII Investor Sentiment. That's the Individual Investor Pulse Check. And the NAAIM Exposure Index. Yes, we got lots of acronyms here, but this one is big. It's pro-positioning, how investment managers are actually lined up, from cautious to fully invested. Then we have market-based indicators. You probably heard of the VIX Volatility Index. This is the price of insurance on the S&P 500, how the pros are feeling about the market 30 days out. When the VIX is low, protection is cheap. And when the VIX is high, institutional investors are paying up to protect themselves. Then there's the SIBO put-to-call ratio. This is options traffic. And traders buying more protection, are they buying that or are they chasing more upside? And though it's not shown, you could also throw short interest in here. How many people are betting against a stock? Because that's another window into bearish energy. Then we also have credit spreads, and this measures the stress in the bond market. When spreads widen the cost of money to riskier borrowers, it goes up, and lenders get nervous. And when spreads are tight, credit is basically saying things are fine for now. And finally, there are market internals. This is the under the hood check, what we call breadth. How many stocks are actually participating in a move, and are markets concentrated? Now let's see where all of these indicators are lining up right now. So first, consumers are feeling down, and they're not feeling very well. Consumer sentiment is hovering near multi-decade lows. Prices have gone up, jobs are getting harder to find, and everyone still remembers the sticker shock from recent years. But when it comes to markets, investors seem okay, even calm. So take the VIX, which is now under 15, very quiet. The pros are not too worried about a market shock, but the positioning gauges are showing that many investors are heavily exposed. That tells you right there that there's big risk appetite, which is great, but if that gets to be too big, it can be a contrarian indicator that things are getting crowded. And finally, under the hood, things look okay, but we should be on alert for cracks. Market internals are showing decent participation, and credit spreads are still historically low. And then thinking ahead to 2026, we know that Main Street feels bad, but Wall Street feels okay, and that gap can last a while. So it's where the most important signals live. So watch those credit spreads. If credit starts to tighten its belt, stocks tend to take notice shortly after. Then watch for a VIX regime shift. One spike probably doesn't matter, but it does if the VIX stops falling back down after a pop. That is, if the market starts pricing in a new baseline of stress. And keep an eye on breadth. If participation rolls over while prices keep climbing, that is a classic warning light. And then there's positioning. Watch those surveys of the pros and retail investors. When everybody's all in, there's less fuel left. And when everybody starts de-risking at the same time, moves can get magnified. Finally, keep tabs on jobs and inflation expectations. If people start expecting more layoffs or they stop believing prices will cool, that mood can turn into real behavior. Less spending, more caution. Much like life, the feels of the market and the economy can be messy, but when the big picture starts changing, things usually line up quickly, and that's when you can get some of the cleanest signals. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find.
Biopharma stocks have had quite a ride in 2025. They faced serious headwinds in the first half of the year in the form of tariffs and policy uncertainty. But as some of those concerns eased from July to December, biopharma stocks had their best 6-month period in a decade. My next guest sees reasons for this trend to continue into 2026. For more, I'm joined by Evan Seigerman, BMO Capital Markets Managing Director of Biopharma Equity Research. He's with me now. Evan, it's great to see you. And I'm really curious to hear your thoughts for next year. I want to start with policy, right? Because this is something that is still evolving, depending on your perspective, I guess, in terms of sort of pricing pressure from the administration. What are the implications of that for the biopharma industry?
Well, first off, thanks for having me ahead of the holiday this week. Into 2026, we've had a bit of resolution, including some deals last week with the administration and several biopharma companies that I cover, helping kind of lay out groundwork for drug pricing, the MFN pricing that we had talked about. So that is a good kind of removal of a policy overhang. I think there's still a lot of concern around the FDA. That still seems to be a bit in flux. I know there's always been articles, it seems, in the Wall Street Journal, the New York Times, highlighting a bit of disarray with some of the folks at the FDA, which is a concern for my sector. So all in, we are cautiously optimistic. You know, we like the deals that we're seeing with the administration. They are far worse than folks had feared. Tariff fears are going away, but you know, you need the FDA for this sector to work. And that's where, if I were to point to one specific point that I'm concerned about, that's where it would be.
In other words, the FDA not approving drugs, not working as it's supposed to in as efficient a fashion. Is that where the concern lies?
Well, they're approving drugs, but it just seems to be kind of shooting from the hip in terms of policy. There had been this thing called the Commissioner's Priority Review Voucher. There was an article last Friday in Stat News, for example, highlighting the potential legality around it. And then this small company that I cover, Disc Medicine, they were mentioned by Vinay Prasad as with their drug may not being as effective as some had thought. All hearsay, but it definitely kind of put the stock in a tizzy and just creates that uncertainty, which is the big issue that I think makes it harder at some point for someone to invest in the sector.
And then to come back to the pricing negotiations for just a minute here, as you said, it's not the worst case scenario there for pricing. And it doesn't affect a very broad swath of drugs at this point. But is it going to, at the margins, eat away at profit margins for these companies, or is it something that's sort of negligible?
It's, there's always going to be some impact, right? If you're getting less, even if it's in a small portion in Medicaid, for example. When you look at kind of what Bristol did with Eliquis, that's going off patent in the next, year or so. So that's less of an issue. And then some company like Gilead, Biktarvy was spared from the negotiations, and that's their key HIV drug. Gilead is one of our top picks into next year. So they were able to negotiate some of their older drugs to be part of this program, which shows how these companies understand how to give the administration what they want while preserving what's most important for their businesses.
One of the other themes I know you're looking for next year is some M&A. We've been talking about the patent cliff for a long time now. I mean, it's sort of a rolling patent cliff for a lot of companies, but a lot of companies will be losing their exclusivity for certain drugs, and you think that's going to drive them into the market and make some purchases. So how, as an investor, do you try to take advantage of that?
Well, I mean, it's you always want to pick the company that's getting acquired, which is hard to do. I think buying the XBI is always a great place to start. The XBI is up quite a lot this year. But more specifically, if you're picking stocks, you have to find companies that have high quality de-risked assets. That's why we do like at Disc Medicine, for example. It's our small cap top pick. Of course, definitely we'll probably see something in the obesity space. We know Structure Therapeutics, for example, had some great data earlier in December. So a long way of saying, if a company has a drug that has differentiated data, has shown to be effective and unique, that is going to be an asset that is going to be looked at by big biopharma.
And just for folks keeping score at home, Disc Medicine, the one that you've mentioned a couple times, IRON is the ticker on that one if people are looking for it. IRON, like the thing that you iron clothes with. Of course, we can't have a conversation without mentioning GLP-1s and obesity. For that one. Of course, we got to talk about it. Some kind of oral medication is the next stage here. So what do we watch there in terms of the horse race of who's going to be first to market?
So between now and the end of the year, I expect the Wegovy pill, so Novo Nordisk's oral option, to be approved. We know that they're going to be launching it come January. And then at some point in the first half of next year, potentially March, Lilly's orforglipron is likely to be approved. The dates on that are less firm because they're still working through kind of a priority review voucher there. But what that does is open up the space to highly effective oral options. We can parse through kind of which is better. I think they're both great for different patients. The Wegovy pill is a little more efficacious, whereas orforglipron has some more flexibility around dosing. What this does is it expands the market and gets GPs prescribing GLP-1s, which should help get more patients on these products, get folks who are needle phobic. So all in, it's still bullish on the GLP-1 space. We like Lilly, but we are definitely watching what Novo does with the Wegovy pill or whatever it's called as soon as they launch it.
Evan, gotta leave it there. Thank you so much for joining us, and Happy New Year if we don't talk
Happy New Year to you.
Thanks. Coming up, we got full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere.